Good evening, everyone. Welcome to the Winpe Ignite Masterclass Series 1. We are ready to start, and a message to those participants whose Zoom name is not on our list of registered participants. Please either update your Zoom ID to match the one you have used for registration, or in case you haven't registered, please use the link in the chat box to do so. We'll post it on the chat box. Now, for those of you who don't know us, Winpe is a pioneering not-for-profit platform driving gender diversity in the investing ecosystem by increasing women's participation as investors, capital allocators, and recipients of investment capital. We work closely with PEVC firms in helping them shape and execute on DEI strategies, including hiring more women across roles and levels. When we launched in 2020 and we heard our member PEVC firm saying we want to hire women but we can't find them, we were skeptical because we thought there are enough women keen on PEVC careers. In the last more than 4 years, Winpe has undertaken a number of initiatives aimed at supporting PEVC aspirants, including job bulletins, AMAs with industry leaders, boot camps with recruiters, and career fairs. Through these initiatives, we have also come to realize that the talent pipeline in women for PEVC is much thinner than we would have liked for various reasons. Ignite by Winpe is a platform designed to support the women talent pipeline in the PEVC, private equity and venture capital industry. Ignite offers online career sessions, masterclasses, job vacancy information, and a profile bank of women interested in PVC roles, accessible to member firms in an anonymized format. So when a PVC firm hires, they can access our profile repository for candidates. The profile bank is open to women at all levels, including those already in PVC. And as I said before, we hide the candidate and firm names in the database that is shared with hiring firms. So they are anonymized. Now, please join the Winpe Career Network WhatsApp group to join the Winpe Ignite profile repository. This group will also keep you updated on our sessions and with information on job openings, which we keep posting there. I'm sharing the group link on the chat box. Now, moving on to today, our topic for today is term sheets, a practical guide to negotiating deals. Today's session will be followed by a series of 2 more masterclasses series starting in the coming week. Now, before I introduce our trainer for today, a reminder that if we do not find your name in the registration list, we will have no choice but to remove you from the webinar. So please either update your display name or fill out the registration form. Link is in the chat. Introducing our trainer, Divya Mundra, a senior partner at AZB Partners. Divya has 15 years of experience and specializes in mergers and acquisitions, joint ventures, general corporate, and private equity. Divya represents a range of domestic and international clients across various sectors, including agriculture, banking, fashion, healthcare, luxury goods, media, retail, and technology. Now, some housekeeping notes. The session is being recorded and an edited version of this recording will be made available for future reference. You can type your questions anytime during the session and Divya will pick it up, the questions as and when or at the end of the session. Now, without further any delay, let's get started. Over to you, Divya.
Thanks, Ankita, and hi, everyone. So as Ankita mentioned, I think the topic that we want to kind of at least touch upon and cover today is term sheets. Now, the endeavor during the course of this session is going to be for all the participants to at least go away with some idea of why we need term sheet, what to keep in mind as we are talking about term sheet, what are the different aspects, what purpose does it achieve, binding, non-binding, etc. I am aware that I think most of the participants are non-lawyers. and are working professionals in the early stages of their career. So I will try to keep it as non-legalistic as possible, and happy to take any questions, or if there are any clarifications, any specific points that you would like me to touch upon or elaborate further on. Happy to address that as we go along. With that, I think, Ankita, should we move over to the first slide?
Yeah, I'll just share the screen.
Thank you.
Is it visible?
Yes. Okay, we can move to the next. Yeah. So when we talk about term sheet basically is kind of a summary of the key items or the broad principles that parties to a transaction have agreed upon, which basically serves as a guiding tool for when we were to go down and deep dive into the actual transaction documents. When we talk about how to structure a term sheet, what's really relevant and the approach that we take in that regard will depend on a number of factors, which is what is listed out on this slide. Essentially, if the transaction involves a listed company, the approach will have to be slightly different because of SEBI considerations, insider trading regulations, disclosure obligations, etc. Whereas if it's for an unlisted company, the considerations are going to be different. When we talk about, again, the kind of provisions that will form part of the term sheet, it will depend on the nature of the transaction. So, i.e., whether it's a minority financial investment into a company versus a majority strategic investment. Are we talking about a joint venture, for example? And then based on the purpose of the investment. So if it's a strategic investment or a joint venture, the approach will be very different from when we talk about a private equity or a financial investment. And things to keep in mind as we are drafting the term sheet or discussing a term sheet in that context. Broadly speaking, in addition to whether it's a minority, majority transaction, strategic, private equity, financial investment, I think what is also relevant is to understand what fundamentally the transaction is. So is it, for example, a primary infusion of funds into a company, which will involve issuance of fresh shares by the company? Or is it a secondary transaction? What do we mean by secondary transaction? It's essentially a transaction involving sale and purchase of shares which are already in existence. So a transaction between the shareholders of a company and another entity who's looking to purchase shares of an entity. The third type, broadly speaking, could be a business transfer or an asset sale, which, as the name suggests, does not involve transfer of shares or issuance of shares, but is a transaction involving sale and purchase of assets or business of a target company to another company. So essentially, the approach that you take to a term sheet, the lens that you have to view a term sheet with will depend on the nature of the transaction and the factors that we have set out here. We can move to the next slide. Now, broadly speaking, before we jump into the term sheets and what would be typically the clauses which would form part of the term sheet, I think important to understand the various stages involved in a transaction. And here we are talking about really an M&A transaction. So the first stage is really the structuring. When we talk about structuring, we basically mean what the transaction structure is going to be like. So whether it's going to be a primary, secondary, combination of the two, what instruments are we talking about? Is it going to be a straight equity deal? Is there going to be a component of debt? Is there going to be a hybrid instrument? What makes sense for both the buyer and the seller from a tax perspective? So structuring is that part, which is basically the first step and to identify the broad contours of the transaction. Fundamentally, what is it that is the intention of both the parties in terms of the final outcome to be achieved. Once we have that, then we typically move to the term sheet stage. So now the term sheet and the purpose that the term sheet really serves is, like I said, to provide broad guiding principle. The idea is that before parties invest more time, effort, money, and energy on pursuing a deal or exploring the deal in greater detail, at least the parties should arrive at some consensus, or there should be some meeting of minds on some of the critical items, because nobody wants to engage lawyers, advisors, start the diligence process, spend money on all of this without even having certainty or meeting of minds on some of the key terms of what the deal looks like. And therefore, term sheet essentially serves that purpose, which is to identify what these key topics should be, what is the negotiation that the parties, or what is the final position that the parties are comfortable with on certain key items, and we'll go into what those items typically include as we go along. But that is really the first step when it comes to the commercial terms of the deal, which gets documented in this term sheet. Once the term sheet has been executed, that generally serves as a starting point for the parties to start the due diligence process. Now, what do we mean by the due diligence process? The due diligence process essentially has various considerations to be kept in mind. So, due diligence will typically involve financial due diligence, tax due diligence, commercial due diligence, legal due diligence. Idea being for an incoming investor to basically get a sense of the state of affairs, both from an accounting, tax, legal, commercial perspective, and to basically identify whether the assumptions that form the basis of the valuation and the deals are in fact correct. And also, to the extent they are able to identify any liabilities or potential roadblocks or potential counterparty issues, how well to document it in the transaction document as we go along. So due diligence is basically undertaken in almost all transactions, regardless of the nature of the transaction, with the main objective of trying to identify the risks involved, whether there are any red flags, and thereafter to try and find ways to mitigate such risks. And therefore, to that extent, it's essentially the first step that parties undertake post execution of the term sheet. Once parties have completed due diligence, and sometimes simultaneously with the due diligence process, parties start discussing the transaction documents. Now, if we were to ask, what is the difference between term sheet and transaction documents? The transaction documents are nothing but long form documents, which set out in detail the key terms which have been agreed in the term sheet, and also over and above that, the other ancillary terms which may or may not have been a part of the term sheet, but are important in terms of the contractual understanding between the parties. That gets documented in the transaction documents, which are binding in nature. So once we sign the transaction documents, there is a commitment, there is a binding contract between all the parties, which, if not fulfilled, or if there is a breach of the transaction documents, there will be consequences of the same, because it's a binding contractual commitment. Once we agree on the form of the transaction documents, we move to the execution phase, which is basically where we sign up to these transaction documents. So once we have the documents in agreed form and parties are ready to move to the next step to actually implement the transaction, that's when we sign the transaction documents. The transaction documents typically contain what we call conditions to closing or conditions precedent, which, as the name suggests, are things that either emanate from the due diligence findings, so items which are required to be cleaned up, rectified, or where certain steps need to be taken to mitigate the risk. And in order for the investor to be comfortable with, the way the company financial position is, contractual framework is. So those cleanup items, as well as some regulatory approvals if the transaction requires a regulatory approval, as well as all the corporate compliances associated with the actual completion of the transaction. Those need to be completed in the time period between execution of the transaction documents and the actual closing of the transaction. What do we mean by closing of the transaction? That is the final step, in the sense that where you actually proceed to complete the underlying transaction, be it issuance of shares, transfer of business, or transfer of shares. So the actual transfer of the asset is what is defined as closing. Once the closing has occurred, there could be certain action items or obligations that the parties may have agreed to, which may not have been as critical as to form part of the condition precedent or required to be done before we close the transaction, but are nevertheless still important and therefore are included in the documentation as a post-closing action, which the relevant parties need to undertake after completion of the transaction. But the difference really is that there is a contractual commitment out here for them to actually undertake those actions, as opposed to just running the business in the ordinary course or something that they would have done as part of ordinary course. Here, there's something that they've signed up to do. The only thing is that the timing of completion of these actions is after the transaction has been completed. In other words, neither party has the ability to walk away from the transaction if these conditions are not completed. If a condition precedent is not completed, then it gives the party in whose favor the condition has been included to actually walk away from the deal. And therefore, despite having entered into binding agreements, there is a risk or there is that uncertainty that the deal may not go ahead unless those critical items are completed, satisfied, and the transaction or the target company and the state of affairs of the target company is such that the investor is happy and satisfied, and therefore finally proceeds with completion of the transaction. These are broadly the stages of a deal. And I think what we are going to be spending more time talking about today is essentially the term sheet. And thereafter, due diligence, drafting, execution, closing, post-closing are all action items that follow execution of the term sheet. We can move to the next slide. Okay. Now, when we talk about term sheet, one of the first questions really is that what is the purpose that the term sheet serves? Is the term sheet a binding term sheet or a non-binding term sheet? What do we mean by binding versus non-binding, and how does that impact the overall transaction? I think what we are trying to, the difference really between binding and non-binding really is in terms of the consequences of not following through with the transaction even after execution of the term sheet. So a non-binding term sheet, which is more what we see more commonly, is essentially serving the purpose of parties having agreed to the broad contours of the transaction, some sort of meeting of minds on some of the key topics, where at least the hope and the expectation is that even though it's non-binding, these are the positions that the parties are morally committed to because this is what they have agreed to as the basis of the transaction. So therefore, what the term sheet will identify is what is the nature of the transaction. Is it going to be a primary issuance? Is it a secondary sale? Is it an asset transfer? Is it a business transfer? So the transaction structure is something which will form part of the term sheet. It will also identify what the definitive documents for the transaction are going to look like. So whether it's going to be a share subscription agreement, shareholders agreement, whether they're going to be employment agreements for some of the KMPs, whether we need a non-compete agreement, the term sheet will kind of try to list out what these key definitive documents are going to be and who are going to be the parties to this document. So later on, there is no doubt or debate regarding whether a non-compete was envisaged at the time when the parties even started discussing the transaction terms. One of the critical things which would almost always form part of the term sheet is the broad valuation of the business and the underlying assumptions subject to verification as part of the due diligence exercise. This will typically include the enterprise value, the commercial understanding regarding whether the transaction is going to be on a cash-free, debt-free basis, what are the adjustments envisaged, what is going to be the target working capital limit, what is going to be the EBITDA achievement, so what are the assumptions on the basis of which a certain valuation is being agreed to between the parties. Always with a caveat that all of this is subject to completion and verification as part of the due diligence process to be included or to be undertaken after execution of the term sheet. Now, although I mentioned that the more commonly used form of the term sheet is the non-binding one, yet in addition to generally identifying or parties agreeing to the broad contours of the transaction, the term sheet also serves another important purpose, which is exclusivity. Now, what do we mean by exclusivity? Exclusivity is basically a commitment on the part of the seller of the transaction to not pursue an alternate transaction with any other party. So, unlike the rest of the term sheet clauses, this is one of those clauses of the term sheet which is typically binding in nature. So, while your term sheet by and large may be a non-binding term sheet, sometimes parties prefer to enter into a term sheet only to lock in the exclusivity, which is specifically identified and called out as a binding provision of the term sheet. When we say binding, what we really mean is that tomorrow, if your term sheet has exclusivity clause and that exclusivity clause is specifically identified as a binding provision of the term sheet, and it turns out that there is a breach of that clause, there is a contractual claim for breach of the term sheet, which is available to the non-breaching party in that case. And therefore, often investors insist on a term sheet just to lock in the exclusivity because they do not want to be engaging advisors, incurring costs, unless they know that they are the only or the sole, bidder in the running, and that the company is not really shopping for other investors or using the offer which has been presented by one investor to get other investors. And therefore a lot of discussion ends up happening around what is the correct term of the exclusivity. Should it be 30 days? Should it be 45 days? Should it be 60 days, 90 days? And obviously, from the investor's perspective, the longer the exclusivity, the better it is. Whereas from the target company or the seller's perspective, they would want it to be as tight as possible because it's ultimately an obligation on them and a restriction on them from pursuing other similar transactions with other potential investors. The second clause of the term sheet, which is generally binding, is the confidentiality clause. The confidentiality clause in here, we've seen a combination of approaches. So sometimes parties prefer to enter into a separate non-disclosure agreement or an NDA, as it's commonly called, which contains the confidentiality obligation. And the term sheet includes reference to such NDA as being one of the binding sort of provisions which is incorporated or deemed to be incorporated into the term sheet. But confidentiality is also, to the extent it forms part of any term sheet, is generally one of those few binding clauses in the term sheet. And the other binding clauses are your governing law, jurisdiction clause, important because you have other binding clauses. So tomorrow, if there is a breach of the exclusivity and a party wants to sue the other, then they will have to follow the governing law and dispute resolution clause as specified in the term sheet in order to proceed against the breaching party. The term sheet also identifies what broadly the conditions precedent are and what are so the conditions precedent can be bucketed into two or three important categories. There could be contractual conditions precedent where which could involve getting a third party consent under a contract, whether it's a lender contract, whether it's something with a commercial counterparty, or it could include regulatory approvals depending on the sector to which the target company is engaged in. So those are also, the idea is to try and identify some of those because these will then form part of the conditions precedent. And in addition to ensuring that the transaction happens in a compliant manner, the conditions precedent also, one has to be careful because ultimately it has an impact on the overall timelines for deal closure, because unless those conditions precedent are satisfied, parties will not proceed to completion. So the identification of those conditions precedent and understanding of how long it's going to take to satisfy those conditions precedent becomes critical. The next point is, and what we would typically include in the term sheet are the other rights and obligations and restrictions. So this again will depend on the nature of the transaction. So if it's, for example, 100% buyout of an entity, the rights, obligations, restrictions will be bare bones because the incoming investor is going to be 100% shareholder. So we need not worry about any shareholder, interstate shareholder rights, obligations, restrictions. We may be more worried about things like non-compete as far as the exiting, selling shareholder is concerned. If it's going to be a joint venture or if it's a financial investment by a private equity investor, then of course we will have to think about clauses like the transfer restriction. Do we want a lock-in on the existing shareholders? When should we have the ability, especially in the context of financial investors? What is the exit? Who is guaranteeing the exit? Is there going to be a waterfall for exit? What is the time period horizon? So those are also the clauses that in some shape or form is included in the term sheet. The last point on this slide is very important because often what we've seen is that as lawyers, where parties choose to go down the term sheet path. So uh, not every transaction starts with a term sheet. Sometimes it's just agreement on some of the commercial terms like valuation, purchase price, and then parties want to straight away jump to the diligence after having binding exclusivity agreement and then move straight to the long form definitive documents. But in some cases, parties have a strong preference to have a term sheet because they at least want to ensure that there are no big gaps on some of the major items, which they try and achieve through a term sheet to just see how far apart they are on some of these critical items. Now, the trick here really is how much time do we want to spend on this term sheet? Because we've seen that in some cases, the discussion on the term sheet uh, tends to go into some sort of a loop. From an investor's perspective, the term sheet is intended to serve very limited purpose, which is basically to lock in exclusivity and start the diligence. The idea is not for this to be an exhaustive document. The when we do the long form agreements, we should be prepared that a lot of things which may have been agreed to in the term sheet will get reopened, will get discussed in detail. And therefore, the idea definitely is not for the term sheet to be an exhaustive document. It's more to ensure that some of these things like confidentiality, exclusivity, we quickly agree on that, quickly agree on the broad framework of valuation, and then move on to the next phase. Because once the diligence findings are available, there will be a lot of these items which will require further discussion and also adjustment even to the valuation that we may have agreed to as part of the term sheet. And therefore, at times, the approach that we generally advise our clients to follow is a middle path where for some things like, say, for example, if we are representing the investor and it's a financial investment and financial investors typically have a limited or a fixed horizon and they would want a clear path to exit. So some of those clauses which are important for the investors, we ask them to only focus on that, on those clauses, have an agreement, a broad agreement on those clauses, and leave the nuancing, leave the detailed discussion to a later stage when we actually start negotiating the definitive documents, because we don't want to keep going back and forth on the term sheet and spend 2 months, 3 months just negotiating the term sheet. So the art really lies in what is it that you want to quickly kind of get to an agreement on, and what are the things that will anyway get reopened when we do the long form, and therefore it doesn't make sense to waste time on those points at this stage. Maybe I'll just pause and take some of the questions that are there. So I think the first question is, what are the key terms that protect investors in downside scenarios? Okay, so one of the things which we find, and again, I'm talking about a scenario which is where the assumption is that it's an unlisted company. Let's talk about also a scenario where we are talking about a domestic investor. So we are not really focusing on the nuances and the complications of TEMA. But in a downside, the most important way to protect the investor is by including what we typically call an anti-dilution clause. And the second is a liquidation preference clause. So what do we mean by anti-dilution? And anti-dilution basically means that if today I'm making, and this is a very simplistic example, but if today I'm making an investment where I'm coming in at 100 rupees a share, and tomorrow the company wants to issue shares at 90 rupees, obviously from an economic perspective, it's a down round as far as I am concerned, because I have come in at a higher price, and therefore the provision will provide that the company effectively needs to make good the difference by issuing free shares or shares at a nominal price to me, such that my average price effectively becomes 90 rupees. To put it simply, that's what an anti-dilution clause does. Liquidation preference, which is typically found in not straight equity deals, but more in the context of where we are dealing with compulsorily convertible preference shares or compulsorily convertible debentures, is that in any liquidity scenario where either the company has sold substantial assets and is now sitting with cash, or if there is a sale of change in control at the company level where more than 50% or the majority of the shareholding of the company is being sold to a third party, and there are proceeds or there is cash inflow, I, as an investor, should be at the top of the preference chain when it comes to distribution of that cash, such that I at least get back my principal amount that I have invested. So I have priority or preference when it comes to any liquidity events. So although it's called liquidation preference, it's not just limited to an insolvency or a liquidation type of scenario, but it essentially is an attempt to try and capture all scenarios where there is liquidity and cash, and then who has first access to that cash. So broadly, that is how investors would seek to protect themselves in downside scenario. The second question is, what are common negotiation mistakes investors should avoid? Now, I think here what is really important is that the investor should have clarity on what are the must-haves, what are the good-to-haves. Because often we get lost in trying and over-negotiating good-to-have theoretical concepts or theoretical scenarios and forget the larger picture and what we really care about. And here, often when we are advising investors, we also, as I was saying, we also uh, request them to just try and see at what point we want to stop negotiating the term sheet and want to and want to move to the next stage, because it doesn't make sense to spend 3 months negotiating a term sheet. The idea should be to quickly get the basic terms agreed upon and then move on to the next stage, because this is just the start of the deal. You don't even know what are the liabilities sitting in the company, what are the assets like, have you been able to verify all your valuation assumptions, so you know that things are going to change in the future anyway. And therefore the advice that we often give our clients who are investors is to, A, do we even need a term sheet, or should we just have an agreement on the valuation, sign an exclusivity agreement and move on? Or if we need a term sheet, what is the level of detailing that we want right now? Do you want to just talk about the exit and agree to some of the key principles for the exit and leave the rest as something that we will discuss as we go along and draft the dev docs? So that is the other thing that we generally advise our clients to think about. The next is, could you please elaborate on the CPs and the CS? What should be considered at the term sheet stage? So at the term sheet stage, a lot of these CPCSs are included as broad language to say such other CPs as emanate from the diligence findings, or such other CS as the parties may agree to in the definitive documents. Because as I have been saying, the term sheet is typically entered into even prior to the diligence exercise. So you don't even know what approvals may be required, what cleanup actions will be required to be undertaken. And therefore, some of those which are commercial in nature. So, for example, if you need the founder to sign up to a new employment agreement on terms which are acceptable to you, then you would want that to be called out specifically in the term sheet, because that's more a commercial deal which you want to be clear about upfront. If you want an ESOP policy to be put in place, and that you want in an agreed form, then that is something you would definitely call out in the term sheet. Similarly, if there is a business plan which the parties need to agree to for the next 5 years as a condition precedent, we will call out that in the term sheet. So the idea being that whatever is commercial in nature, parties are already aware of, we should include that in the term sheet. But equally, we need to leave room for further additions, modifications to the term sheet based on the diligence exercise. So you will normally also have the broader language, which will basically say that such other items as may be discovered in the course of the diligence and documented in the transaction document. And the same approach goes for CS as well. Normally, you will not go into as much detail on CS items in the term sheet because given that you are anyway taking a call that's not critical enough for you to have a walkaway right on, it is something that can be discussed when we do the dev talks and need not be taken up, at the term sheet stage. Uh, that was the next question. Have heard stories like VCs have rolled term sheets in less than 24 hours. How do things work there? So often what also happens is that a lot of these term sheets and sometimes investors don't even involve lawyers because there are some standard templates of term sheets that some of these PE VC investors typically follow. Because, like I said, I think the VC investors are conscious of the fact that they do not want to engage advisors until the deal is at a certain stage of maturity. And two, just given the number of deals and the volume of deals that happen in India, most of these investment professionals are fairly well versed with the key terms, what to ask for. There is a lot of clarity of thought in terms of what to really ask for, what to push down the road to the next stage, what is critical for the term sheet. They normally have a template. They know exactly what is the level of detailing they want to get into at this stage. And often with our clients also, we sometimes get precedents from the clients on the format of the term sheet they would like us to use and the level of detail they would like us to go into in the first draft. Sometimes we don't even have term sheet. We have what we call a letter of intent, which is just the broad principle and narrowing some of the commercial terms, and then that's it. Nothing else is required to be agreed upon, only exclusivity and the valuation and the price and move on. So term sheet, to be honest, I think how long or how short the term sheet is, what level of detail you want to go into, there's a lot of flexibility. And the approach again depends on who the investor is, what is going to be the stake, what is the transaction structure, how sophisticated the company is. And that on the basis of that, you kind of take a call on what are the key terms that you would certainly want agreed to as you're putting together the draft of the term sheet. In a scenario when the promoters eventually want to exit the business but have agreed for a minority and exit with investors, how do we contractually ensure promoters remain engaged to eventually provide an exit to investors? Drag may not work in this scenario. So I think drag in any case has its own issue. So even, and you're right, that drag is not a very commonly used exit mechanics because normally drag enforceability of a drag from a legal perspective is a challenge. Secondly, even in it's become less common in the last few years, and even in cases where we've seen the drag provision being included, it's usually as a deterrent, more as a negotiating tool, and really as a measure of last resort if everything else has failed. Now, and if the promoters are eventually wanting to exit the business, I think in any event, if the investor is coming, and this is a founder-led company, so not a professionally managed, but a founder-led company, typically the investor will not be comfortable with the founders trying to look for liquidity or exit for their shares while the investor is still invested. So normally you will have some sort of a lock-in, which will be imposed on the founder shareholding, where the founders are individuals and they need flexibility for liquidity purposes, whether it's for kids' education, kids' wedding, buying a house, etc. There may be some limited sort of liquidity sale, which may be permitted up to a certain number of shares, which is normally non-material. But other than that, you would want the founders to have a skin in the game for at least, depending on your investment horizon, maybe 18 months, 2 years, etc. And even after that, if they are looking for an exit and where they are a majority and you're a minority, you would want to have the ability to tag along, which is basically if they want to sell their shares after expiry of the lock-in, and depending on how much they want to sell as part of that deal, you should have the ability to require the same purchaser to buy shares from you as well. And if they are not okay with buying your shares, then the founder is also not permitted to sell. So you have the ability to tag along with the founder after expiry of the lock-in. So the lock-in term again is a matter of commercial discussion depending on the stage of the company, stage of the investment horizon, etc. But after expiry of the lock-in, where we are a minority shareholder, we would certainly expect a tag along right where the majority is getting some liquidity or is getting some exit. The other way of binding the promoter is essentially in the form of employment agreement, and to see how the founder can be incentivized to actually remain interested. Normally, all of there's also an ESOP pool. There are management incentive plans. There is normally a payout or an upside share linked to the performance of the company. So there are various ways, both as part of the shareholding arrangement as well as employment related arrangement, to try and ensure that the founders continue to remain interested in the business. And we don't want to be in a scenario where we are representing the investor has put in fresh money, and the very next day the founder, just gets up and wants to exit the business. That is something that we definitely try and protect in the document through lock-in mechanism, through tag-along mechanism, etc. Are there any more questions? I think we have. Yeah, I think we have answered all the outstanding questions. Okay, maybe we move on to the next slide.
Yeah, just before we move on to our next slide, we are just launching the poll. Um, just give a few minutes and please vote on the poll. Closing the poll now. Over to you, Divya, again.
Okay, I think, we are kind of done with the session. The next slide is more on the typical kind of transaction documents that we see, which is more depending on the nature of the transaction. So whether it's a share purchase agreement, which is essentially to document a secondary transaction between a buyer and a seller, So sale of existing shares, so no new shares are being issued. A share subscription agreement, which is where a fresh issuance is happening. So the difference really between share purchase and share subscription, other than the obvious, which is that in one case you're getting fresh shares versus where there's a sale of existing shares, is who's going to be a party to the agreement. So typically in a share purchase agreement, it's going to be between the seller and the purchaser, whereas a share subscription agreement is typically between the company and the investor. And in some cases, you would want the founders to also be a party to stand behind some of the obligations of the company. The third is the shareholders agreement. This is important where you have multiple shareholders, and this is essentially to govern the inter se rights. So all that we've been discussing all along, whether it's anti-dilution, preemptive right, liquidation preference, transfer restrictions, non-compete, all of these governance related, board rights, all of these will form part of the shareholders agreement. Business transfer asset purchase agreement obviously is only relevant where the transaction is intended to be structured as a business transfer or an asset transfer. And finally, joint venture agreement, which is different or has elements of a shareholders agreement, but slightly different in the sense that this is more a partnership of two strategic investors. And the key clauses in a joint venture agreement, which differ from a normal shareholders agreement, is the role of each of the parties, the contribution of each of the parties, and what each party brings to the table, what should be the deadlock mechanism, should there even be an exit because it's more of a strategic partnership, will one shareholder provide an exit to the other, and so is therefore there a path to 100% acquisition depending on the nature of the partnership, the commercial objective. But a joint venture agreement tends to be a little more tricky than a normal shareholders agreement with a financial investor, because with a financial investor the objective is very clear. There is a limited horizon for the investment. There is a clear sort of path they want to exit. They are counting on the founders to run the business, whereas in a joint venture agreement, because it's between two strategics, the whole lens with which one needs to negotiate a joint venture agreement is basically keeping in mind the fact that what happens if there is a dispute and the parties are not getting along. Because here it's both parties are bringing something to the table, and therefore the whole approach is a lot more tricky and different from shareholders. Uh, I think the next slide is talking about some ancillary documents that again form part of the overall transaction. So escrow agreements where we want to have some control over how the money that is being contributed by the investor is going to be utilized. Especially if we want it to be utilized, let's say towards repayment of existing debt, we want to make sure that we have control over the fact that the money is going to be used for the end purpose for which we are actually giving the money. There could be transfer assignment agreements depending in an asset transfer deal, for example, depending on the assets which are moving. Again, same, there could be assignment agreements for other contracts. So these are typically the other ancillary documents. In the context of term sheet, you may or may not be in a position to identify each of these and list it out in the term sheet. And again, you'll basically follow the same approach as we had discussed in the context of CPs, which is to have a placeholder to say that such other agreements as may be required in the context of the transaction. But these are essentially other things to think about as we are looking at the overall transaction. Non-compete agreement, do we need a separate non-compete agreement? Can we fold it into the SHA? Who should be party to the non-compete agreement? What should be the scope? Should it extend only to the founder, or should it also extend to the relatives of the founder, the children, spouse? So all of these are things which get fleshed out as we go along and draft the long form, but some of these will find place in the term sheet as concepts to be discussed and agreed to between the parties as we go along. I think that was the last slide. So we have kind of covered whatever at least I had in mind.
We have one more question, Divya.
What are registration rights? What is the difference between demand and piggyback registration, and how are they different from drag along, tag along rights? So I think the demand piggyback registration is more relevant in the context of IPOs, and especially where we are talking about listing of the company as one of the modes of exit. When we talk about drag along, tag along, these are more relevant in the context of secondary transactions, where the exit is being achieved by way of a secondary transaction. Tag along right is more a right where, as we were discussing in the context of a sale by one of the shareholders, the other shareholder has a right to tag along and require sale of their shares. Drag along is where I have the ability to drag somebody else as part of my transaction. So drag and tag in that sense, again, exit mechanism, but who has the right? And the difference really is, like I said, drag is more in the context of a measure of last resort, very draconian, very drastic. Normally, one needs to think about other things like should there be price protection? Should somebody really be having the right to force another shareholder to sell their shares at whatever deed terms they agree to? Whereas tag, in that sense, is more a right which is given to the transferor of the shares based on a deal which has been stitched by some other shareholder. What should we take care of while negotiating for ROFO and ROFR? So the first and most important question, or the thing to think about as we are talking about ROFO, ROFR, is who are you? What is the hat you're wearing? Are you looking at it from the founder's perspective or the investor's perspective, and who is the restriction going to be on? ROFO normally is less problematic because the difference really is, and for everyone's benefit, the difference between a ROFO and a ROFR really is in terms of price discovery. So ROFO is when somebody wants to sell their shares to a third party, and if the other shareholders in the company have a ROFO, then before I go and sell to a third party, I need to come to the other shareholders and see if they want to make an offer for my shares. And if they don't want to make an offer, I am free to sell to a third party. If they make an offer to me, which includes a certain price at which they're willing to buy my shares, and I say no to their offer, then I can only sell my shares to a third party at a price which is at least equal to or higher than that price. And I also have the ability to accept the price offered by the other shareholders and proceed. So ROFO in that sense is little less problematic. And normally, even financial investors are okay with having a ROFO where they are transferring the shares. ROFR, on the other hand, is more problematic because ROFR basically means that I have, as a transferring shareholder, have gone and negotiated a deal with the third party. The third party has offered a price to me. I am required to go back to the other shareholders and ask them if they would like to match that price and buy my shares. And if they are willing to match that price, then I am under an obligation to sell my shares to the other shareholder as opposed to the third party. Now, the issue with this is that when a third party is aware of the fact that there exists a ROFR, it's highly likely that you may not get, the fair value of the shares, because they know that there is always a possibility that the deal may not happen because there is a right in favor of a third party to match that price. So from a price discovery point of view, the person in whose favor the ROFR is obviously in a much more advantageous position. So if we are talking from the perspective of a financial investor will almost never agree to a ROFR, may agree to a ROFO, but what's really important is that if you are drafting these clauses or negotiating these clauses from the perspective of the person who's giving the ROFO or the ROFR right, a ROFR we should strongly push back on because it really restricts the marketability of the shares. But assuming that we have no choice and have to give, I think we need to be clear about the timelines that we're talking about. Keep it tight. So it's not like an endless process that we have to go through with our fellow shareholder. So have very strict timelines. Make sure whether we want to say that if in case of a ROFO, somebody has offered a price to me, I can sell to a third party only at a price which is 10% more than that. Because if I've offered 100 rupees and you get a third party who's willing to buy it 101, then, am I okay with you selling to the third party? Because that offer is so close to the offer that I had made to you. And then what are the reps warranties that you're willing to give at the time of the sale? So some of these terms we should just be careful and as we are negotiating the offer. But most important thing is the timelines and the process, so it doesn't get just stretched on forever, and it should be something which can happen within a short time frame. How favorable can board observer right be for a lead investor? I think increasingly we are seeing more and more people wanting to have an observer seat, even where they have a director, right? More so from the perspective of a liability, because a nominee director, even if it's a non-executive director, once you've attended the meeting, there is certain liability for the decisions that the board has taken in the meeting, where you have been provided with board papers, you've participated in the discussion, etc. So often, some of the investors prefer to have and actually exercise the observer right as opposed to the right to appoint a director. This also gives you the ability to get some industry experts, some specialists to actually attend the board meeting without really being a director on the board. So yes, it's common, and something that we see both either as a standalone right or in addition to the right to appoint the director. I think that was it. Is CCD a better mechanism to prevent a founder from siphoning money as compared to preference shares? So I think the difference, and I'm not sure if CCD versus CCPS makes a difference from this limited perspective. I think what it really does is that because, and the reason why people choose, and this is something that we will cover in one of the other sessions, is that the reason people choose a CCPS structure is because it gives them more flexibility in terms of, valuation adjustment, especially where you are investing in a company based on future projections and on the assumption that the company will perform a certain way. And then there is a possibility that that may or may not happen. And the CCPS as an instrument, as part of the conversion formula, gives you the ability to adjust the actual number of shares that will get issued to you as part of the conversion, depending on the actual performance of the company at that point. Of course, one of the things that can be built as part of the conversion terms is that in certain cases where there is fraud, there could be a penal conversion where the conversion formula will effectively give you control over the company and things like that. But generally speaking, we use these kind of instruments more as a tool for valuation adjustment going forward. And of course, CCPS and CCD, the difference really is that in a CCPS you get paid out a dividend, whereas in CCD it's an interest, so it's more debt-like in nature. But I think both the intention really is more to kind of take care of future valuation adjustment related issues. Can a CCD be converted to CCPS, one convertible instrument to another? CCD into CCPS is going to be a challenge because effectively you are converting a compulsorily convertible debenture into a preference share, which is something which is going to be a challenge. But what you can possibly do is find a way to extinguish the CCD and then plow that money back into the company as a CCPS, as opposed to trying, because one is essentially a debt instrument. So even when you talk about the share capital of the company, the way a CCD is treated is different from the way a CCPS would be treated. So just a plain conversion of CCD into CCPS may be a challenge. But you can certainly find ways to buy back or basically to extinguish the CCD, pay the cash out to the CCD holder, which can get plowed back into the company as a CCPS. Okay, I think I can't see any more questions, and I think we've run out of time as well. So maybe we stop here for the day.
Yeah, for sure. So thank you everyone for joining us, and we hope you found the session useful. Thank you to our trainer Divya for such an insightful session and for your time. Requesting everyone to share your key takeaways of this session over social media with the hashtags #Winpe and #Winpe Ignite. And don't forget to tag Winpe. We are also posting it on our chat. Join us at the annual Winpe Summit and Awards for the PVC industry on March 20th in 2020, next month. Sharing the registration link on the chat box, which you can also find on our website. And once again, do join the Winpe Ignite WhatsApp group in our database that we share with our member firms to support their hiring process. We've already shared the link to join the group in the chat box. You can see it. And stay connected with us for the second session of the masterclass coming up next week. See you, everyone. Thank you, Divya.
Thank you.